Thanks for tuning in to BQ Prime. I'm Hersh Sayta. Earnings season is behind us, but we have one particularly interesting listed player which has come out with their numbers. Cello World is what I'm talking about, listed at the start of this month, a stellar debut on bourses. The IPO was subscribed 38 times. And we have the management, who's of course the chairman and managing director of Cello World, Pradeep Rathod, with us today. Good afternoon, sir.
Good afternoon.
So straight off the bat, sir, talk to us about growth. 3.5% QOQ growth in this quarter is what we've seen. How should one look at the full year FY24 numbers? It's your first year as a listed company. So how would you be guiding for growth in FY24, and of course some forward guidance for FY25 also, if we may have?
So first of all, we are a consumer company, so we do not really see on quarter. It's year to quarter. We've grown almost 9% in the first half. Because the festival season was a 1 month delay, October was the main month of a sale, plus the raw material, which was at a very low, good level for us, which corrected around 22%. Whereby we passed on almost 5 to 6% in various categories of our sales. So volume growth in the first quarter would be around 14 to 15%. Our value growth was 9%. Going forward for the second half, our projections are that we would be approximately growing at 18 to 20% on value growth. October was a fantastic month for us, and the growth was very high. So this is what we assume, and on a year basis, the growth would be around 15 to 16%, plus the value which has come down because of the raw material price. Otherwise, the growth would be in the range of around 20%.
Understood. And sir, could you give us some insight with regard to this? So RM costs is something you are passing on to your consumers. Is that across product lines? Is that the trend? And is it also because you want to penetrate further? Are you seeing to trying to build a brand? Is that the objective? What's the objective behind passing on RM cost benefit?
No, so RS, it is normally when it goes up also, we definitely put the price up. So we have always been able to scale up our price. But when the price is going too much of down, we definitely will have to pass on. Because we cannot be out of the competition. People will have to pass on, because price point of purchase on every category is there. The demand definitely will grow further because of a right price, what you give to the consumer. So this is the main reason. If you see our gross margin levels in all the categories, we have expanded that by 1 to 2.5% to 3% in all our categories. If you see on a year basis, last year we had a gross margin of 50.2%. In the first half, it is 53%. So we have retained something, what we could, being at a reasonable level of pricing, because the market is not a seller's market. In any case, you have the buyer's market today. You have a competition around you. So at a healthy margin, it is better. We cannot retain everything.
Sure.
If you see, our PET levels also have gone from 15.9% to 17.6% in the first quarter.
Sure. So talk to us a little bit more about raw material costs. They've come off clearly. Do you expect that to sustain? Is this now a normalized level in terms of how you look at RM costs?
See, till October, it was going down only. And now it is established at that price for some time. And I think so for the next 2 quarters, it should be low at this levels, what we are expecting. Even the energy prices like CNG, which we use for our glassware, has come down almost at 40% low from the peak.
Right. And so your margins of 24% plus, very healthy. Overall, when I'm looking at the spaces and pockets you are in, do you expect that to sustain as you are growing?
Yes. So I would tell you that historically we were around 25-26% of EBITDA levels, and that's the level what we want to really maintain. Uh, and I think so for the timing for next 4 to 6 quarters, we are sure we will be able to maintain this and grow at a very healthy growth level also on the top line.
Right. And so some insight into your capacity utilization, because that will of course hold key with regard to how margins continue to shape up, right? And be at that 25 odd percent which you've guided for, if I can call it that.
Yeah.
So how is capacity utilization shaping up for you?
So capacity utilization in our opalware, which was 100% in the March, April, May, June, which has come to 60% because we have added a new furnace in August of this year, and which will give us an additional revenue of around 150 crores going forward. In our other consumer business, we are at 75 to 78%. We still have to sweat our asset furthermore, which can expand our EBITDA margins and EBIT margins. Writing instruments also, we have created fairly large size of capacity now, which is already inbuilt in this. Some small capex, and that would take it to almost last year 285 crores to around 500 crores production capacity. Glassware, which is a new plant, which is a high capex plant, which is coming in March, and the sales would start from the first quarter around June of 25, which will give us a revenue growth of around 100-125 crores in the first year. So, and that will be having a capacity which will be exhausted in next 2 years, which will be in a tune of around 250 to 275 crores. So I think so for the growth, all the expansions what we wanted to do, we have already done. Unless so from next year onwards, we will have a very small capex of around 40 to 50 crores annually.
Understood. Understood. And apologies, just quick clarification. With regard to the glassware, you suggested June of 25 is when the capacity start to kick in. You mean June of 2024? So June of FY25? Just wanted to clarify that.
FY25.
Right, absolutely. Okay. So 150 crore in the opalware will come in FY24 itself, because that started in August, if I'm not wrong. And glassware
no, not 124. 125 is the capacity what we added to our 250 crores.
Sure. So
this year we will be almost using around 75 crores to convert into sale, additional than what we did last year. And in the next year, we will be reaching at around 400 crores in our opalware and 125 to 140 crores in glassware.
Sure. So that's almost 300 crore, 250 odd crore added to the top line for next year at a 20+% margin. So I just want to try and break that down for the viewers, of course. So sir, with regard to capex, I think the short question is any major capex still to be incurred in the current year? Because just trying to understand whether there's a funding requirement left and whether you'd be borrowing anything additional with regard to that capex. I know FY25 you did mention that there is very little to no capex, but FY24, if you can just quickly clarify that.
So we have already in the first half we had done a capex of 107 crores, where we started the opalware fully paid, and glassware we have invested around 60 crores from our internal accruals, and we further for the remaining period of 5 months we have a capex of around 115 crores more, which I think so should be funded from our internal accruals.
Understood, sir. Understood. So, looks like we've got the whole snapshot pretty much with regard to how it's progressing. And so, FY25 growth would be a 20% clip, right? If I'm not wrong.
Yeah. So, our growth definitely for over the next 2-3 years, our target is to grow at around 20 to 23% CAGR on the top line, and we definitely want to beat the growth number in our profitability. It would be much higher than the growth of sales because of the product mix what we are planning over the next 2-3 years.
Right. And sir, just my last piece is with regard to both demand and distribution. Could you talk to us, you are going heavy on the distribution side of things. So talk to us about how that's playing out, how quickly will it play out? And with regard to demand, so you have this, especially in the glassware segment, 20% plus with regard to, your margins in that segment. Now in that particular segment, you'll have roughly we did calculate around 250 to 275 crore of incremental revenue coming through in FY25. How confident are you of the demand in that particular space, as well as if you can cover the distribution piece as well?
See, openware, definitely there is a history and how we could grow, and we know the market now, okay, the way it is growing. Though the first half, the consumer demands were not that good, but I think so we could perform better than the market, the industry. In glassware, it is only an import substitute. There's a high import in our glassware, like tumblers and drinking ware, which will definitely, we just have to convert the market from import to local. So we do not have to create any new demands for the time being. And further, I think so we can, if the markets are good, I think so we'll be exhausting much faster than what I've told you for 2.5 years.
Sure. Sure, super positive. On that note, sir, thank you so much for joining us today. We'll let you go on that one. And thank you for all that perspective. That was the management of Cello World, of course, talking to us about Q2 numbers.